You want to own a fast casual restaurant, something like Sweetgreen. You see the long lines at lunch, the $15 salads, the cult following among young professionals in every major city. You imagine a business that prints money from fresh produce, a brand that cracked the code on healthy fast food at scale. You picture yourself collecting profits from an empire that made kale cool and a salad into a status symbol. Sweetgreen is the perfect case study for this fantasy, because it is the most visible name in the entire category, and because every gate a fast casual buyer runs into shows up in its numbers in plain sight. Here is the first problem. You cannot buy a single Sweetgreen location. The company has never registered a franchise program. There is no franchise disclosure document on file anywhere. There is no application, no territory map, no regional license for sale. Every location from Georgetown to Los Angeles is owned and operated directly by the corporation. You cannot walk into a bank with a business plan for a Sweetgreen and get a loan for it, because there is no such product to buy. The only door into ownership is the stock market. Sweetgreen began trading on the New York Stock Exchange in November of 2021 at $28 per share. By early 2026, that same share traded for roughly $8. An investor who put $1,000 into that initial offering would now be holding an investment worth roughly $150. That is not a salad shop generating steady cash for its owner. That is a stock that has erased more than 80% of its value in about 4 years. So the fantasy collapses before it even begins. You cannot buy one store. You cannot open one location. You cannot apply, because there is nothing to apply for. What you can buy is a small slice of a publicly traded company that has never posted a full year of profit in its history. You become a minority shareholder with zero control over the menu, zero control over pricing, and zero control over the executives making every decision that matters. Having the money was never the hard part. Having the money still does not mean you are allowed in. And even if you somehow were, the entry economics for a comparable fast casual concept would be brutal on their own. Comparable premium fast casual franchise systems typically require a net worth between $500,000 and $1.5 million just to qualify as a candidate. Liquid capital requirements often sit at $250,000 or more, and that is before a single dollar goes toward the actual restaurant. A typical build-out for a restaurant at this level runs between $425,000 and $1.3 million. That figure covers commercial kitchen equipment, custom interior design, point-of-sale and kitchen display technology, and the months of pre-opening expenses before the doors even open. Sweetgreen-style locations run between 1,500 and 3,000 square feet. Every one of those square feet costs money before a single customer walks through the door and orders anything. The real cost of a franchise purchase in any concept like this is never just the cash. It is what you actually receive in exchange for it. You are not buying a business in the way that phrase implies. You are buying a lease assignment, a stack of permits, and the right to operate under someone else's brand according to someone else's rules. If the landlord refuses to transfer the lease, you own nothing. If a health inspector flags a violation left behind by the previous tenant, that problem is now yours. If the franchisor changes the royalty structure the year after you sign, you either accept the new terms or you close. That is the actual entry cost, not the dollar figure. The total surrender of control before you have served a single salad. But none of that even applies to Sweetgreen, because Sweetgreen will not sell you a franchise at any price. So set aside the fantasy of the local shop entirely. What you are really evaluating is a stock, and a stock is a completely different kind of ownership. Ownership on paper is not the same thing as control in practice, and this is where the second illusion breaks down. Consider the actual share structure. As of early 2026, institutional investors held approximately 75% of all outstanding Sweetgreen shares. The three co-founders, Jonathan Neman, Nicholas Jamet, and Nathaniel Rue, together controlled roughly 59% of the voting power. That power came through a dual-class share structure. Their shares carried 10 votes each for every single vote attached to a public share. If you bought in, you would be buying Class A shares, 1 vote per share. No meaningful influence over who sits on the board, no power to change the menu, the pricing strategy, the expansion plan, or executive compensation. The three founders have been running this business together since 2007. They raised $364 million in the initial public offering. They have spent heavily since then on automation, on technology, and on menu innovation. Across the entire history of the company, Sweetgreen has never delivered a positive net income for a full fiscal year. You do not control the brand. You do not control the supply chain. You do not get a vote on adding steak to the menu or cutting a popular side dish, because it slows down the kitchen line. What you own is a floating claim on future cash flows that have not yet shown up. What the founders and the board control is every decision that determines whether those cash flows ever arrive. This is where the next gap opens, and it is the most dangerous one in the entire ownership fantasy. Revenue is not profit. Sweetgreen reported total revenue of roughly $675 million in its most recent fiscal year. That number sounds like a company that has figured it out. It sounds like a business that works. But revenue is only the money that walks through the door. Profit is whatever survives after everything else takes its cut. And at Sweetgreen, everything else takes a lot. The cost of goods sold runs approximately 84% of revenue. That means for every $15 salad sold, roughly $12.60 disappears before a single employee gets paid for making it. Labor eats another 25 to 28% of revenue on top of that. Rent, property costs, and other operating expenses consume roughly $3.78 of every $15 in sales. Stack those layers together, and the restaurant-level margin, which is the profit before any corporate overhead, lands somewhere around 10 to 18% depending on the quarter. That is before technology spending. That is before interest payments on the $356 million in long-term debt the company carries. The number that actually matters to a shareholder is net margin, the profit left after literally everything. As of early 2026, Sweetgreen reported a trailing 12-month net profit margin of roughly 2.5%. That sounds thin but survivable, until you look at what is inside that number. It includes a $160 million one-time gain from selling off a division. Strip that gain out and the core restaurant business is still losing money. You are not buying a profitable salad empire that happens to trade on an exchange. You are buying a revenue machine that has never produced a full year of positive net income in its entire operating history. The top line looks impressive on a slide. The bottom line tells an entirely different story. Here is the part most people never think to ask about, and it is the part that actually explains how a company like this survives it all. The sign outside is not where the real money lives. You walk into a Sweetgreen and you see customers ordering salads at a counter. That is the visible product. That is not the profit center. The real profit engine for a chain like this is the digital ordering platform, the loyalty program, and the data it captures on your payment method and your ordering habits. Sweetgreen generates more than 60% of its revenue through digital channels, meaning the app and web ordering, not the walk-up counter. Every time you order through the app, the company owns that relationship. It owns the repeat behavior and the data that comes with it. That is a connection it never fully owns with a walk-in customer. The hidden loss center is the physical store itself. That $425,000 to $1.3 million build-out does not disappear once the store opens. It compounds every single month through rent, through labor, through food waste, through equipment maintenance. The company's infinite kitchen locations, which use robotic assembly to prepare bowls with far less human labor, reach restaurant-level margins of about 28%. Traditional locations, staffed the normal way, struggle to reach 18%. The gap is not better lettuce. The gap is labor cost, which is the single most expensive variable in the entire restaurant equation. Here is the trap hiding inside that number. The automation division behind those infinite kitchen robots was called Spice. Sweetgreen sold it to a company called Wonder for $186 million in late 2025. That sale produced a one-time gain that made a single quarter's income statement look profitable. Strip out that gain, and the underlying business is still losing money on every bowl and every salad it sells. The hidden profit center, in the end, was not the robots. It was the sale of the robots. The hidden loss center is everything that is left behind now that the sale is done. None of this is theoretical. It has already played out in public, in ways that hit the stock price directly. In July of 2026, Sweetgreen lost more than a quarter of its market value in 4 trading days. The cause was a cyclospora parasite outbreak linked to contaminated produce somewhere in the supply chain. Investors sold the stock on fear alone, even though no Sweetgreen ingredient was ever confirmed as the source in the investigation that followed. The company still lost roughly $250 million in market capitalization before it was cleared. That is the actual risk profile of owning a chain built on fresh produce. You do not control the farm, the truck, the supplier, or the washing equipment 3 steps back in the supply chain. You only own the liability the moment something goes wrong, whether or not it was ever your fault. The same year brought a wave of leadership departures. A former chief development officer named Chris Tarrant left the company, marking the second senior departure inside a single month. Co-founder Nathaniel Rue had stepped back just weeks before that. Same-store sales had already declined for 3 consecutive quarters by that point. Sweetgreen responded by slashing its planned new store openings from 37 down to somewhere between 15 and 20 for the year. The stock was trading around $7.50 per share. That was down more than 77% from its 52-week high of $33.71. These are not hypothetical downside scenarios dreamed up to scare you. They are public events that already destroyed real shareholder capital. And they happen to a company that has never offered a single franchise, never let an individual buy a single store, and never closed a full fiscal year in the black. The risk was never visible from the sidewalk outside the store. It lives entirely in the gap between what you assume you are buying and what the corporate structure actually hands you. Now layer on the debt. Sweetgreen carries roughly $356 million in long-term debt against about $156 million in cash on hand. That is a net debt position of around $200 million. The company pays interest on that debt every single quarter. It has never generated enough operating profit on its own to cover that interest. It has needed help from asset sales and other one-time items instead. Add the labor cost trend on top of the debt. Sweetgreen operates disproportionately in states where minimum wage law is moving in one direction. California has already raised its fast food minimum wage to $20 an hour. New York is actively discussing $30. Every dollar of wage inflation flows straight to the bottom line here, because unlike a franchise system, there are no independent franchisees around the country to absorb that cost locally. It all lands on one corporate income statement. The legal exposure compounds the picture further. The company settled a wage theft lawsuit for $750,000 in 2025. It is also facing a pending discrimination lawsuit brought by 10 former employees across 7 New York City locations. Neither of those numbers shows up cleanly on an income statement until the cases resolve, but each one represents a liability that grows quietly with every month the litigation continues. The real catastrophic risk here was never a single dramatic event. It is the slow compounding of several structural disadvantages at once. The company cannot simply raise prices to offset rising costs, because the customers it would need to raise prices on are already leaving. Same-store sales declined for 3 consecutive quarters. Customer traffic fell more than 11% in a single quarter. You are not looking at a business that can freely pass costs on to its customers. You are looking at a business losing customers faster than it can cut expenses to match, and that is not a temporary rough patch. That is a structural flaw baked into the ownership proposition itself. Getting into this position was, in some ways, the easy part. Getting out cleanly is the part most buyers never think through until they are already trapped inside it. For a Sweetgreen shareholder today, the exit options are narrow and unattractive. The stock trades around $8 per share as of early 2026, down more than 77% from its 52-week high. Total market capitalization has shrunk from more than $4 billion at the time of the initial public offering to somewhere around $1 billion today. The pool of realistic buyers for a struggling restaurant chain is shallow by nature. Private equity firms look for predictable cash flow to lever up against, not negative earnings before interest, taxes, depreciation, and amortization. Strategic acquirers like Chipotle or Cava already have their own growth pipelines to fund, and no obvious need for a brand that has been losing customers year over year. The most realistic outcome is not a buyout at a premium price. It is a slow grind lower while the company either finds a way to turn the model around or slowly runs down its financial runway trying. That net debt position of roughly $200 million means there is very little cushion for a prolonged downturn. Every quarter of negative free cash flow eats further into the remaining cash balance and shortens the window available to actually fix the underlying business. An investor who bought at the initial public offering price has already lost more than 70% of their original investment. An investor who bought at the all-time peak of $33.71 has lost more than 75%. Nothing about the current structure guarantees that the next buyer down the road will pay more than the last one did. The broader competitive picture makes the path back even harder. Sweetgreen faces direct competition from Cava and from Chipotle. It also faces a growing wave of cheaper fast casual concepts that have already solved the unit economics problem Sweetgreen is still struggling with. Sweetgreen's own strategy leaned heavily on automation to close that gap, through the Infinite Kitchen Robotics program. Then, it sold the division running that program before the bet had a real chance to pay off company-wide. It traded away a long-term efficiency advantage for a short-term cash infusion. So, here is what the ownership fantasy actually resolves into. What you thought you were buying was a salad empire with loyal customers and pricing power. What you would actually be buying is a floating claim on a revenue machine that has never delivered a full year of profit. It is controlled by 3 founders holding 59% of the voting power through supercharged shares. It carries roughly $200 million in net debt. It is losing customers faster than it can cut costs to compensate. And it offers no exit path that guarantees you get your money back. That is not ownership in any meaningful sense. That is a claim on hope, dressed up to look like an investment. Sweetgreen currently operates around 235 company-owned locations, and offers exactly 0 franchise opportunities to anyone at any price. Its stock has lost more than 80% of its value since going public. Annual revenue sits at roughly $675 million, against 0 full years of profit across the company's entire operating history. It sold its own automation division for $186 million just to extend its financial runway. That sale produced a one-time gain, and the gain made a single quarter look profitable on paper. The core business kept losing money underneath it the entire time. You cannot buy a Sweetgreen location. You cannot open one. You cannot control one, even if you found a way in. The only thing available for purchase is a stock. That stock has already proven itself capable of destroying more than 3/4 of an investor's money in under 5 years. And the belief that kept people buying anyway has already cost shareholders somewhere around $3 billion in lost market value since the day the company went public. This is what owning a fast casual restaurant like this one actually means. Not a lease you can walk into, not a counter you can staff yourself. A share of paper, controlled by people who answer to no one you elected, in an industry where the margin between a great location and a bankrupt one is thinner than the price of the salad on the menu. The salad was never actually the product being sold here. The product was the story about the salad. And for now, that story has run out of ways to explain itself.